everyone, and welcome to today's educational webinar. Today we chose to talk about the technical analysis, which is one of the key methodologies to forecast the direction of prices in the markets. So what is it based on? What's technical analysis? Mainly a trader would be looking for certain price patterns or a repetition of certain price patterns. So they would be looking at the price history, and based on the price action during a certain time limit, they would be able to base their forecasts for future price performance. So so this is it. Mainly, it's just in brief. A trader would have to look at the charts. These charts will show the price history of a certain financial asset. That doesn't matter whether it is a currency, commodity, stock, even so some traders do some technical analysis for bonds, even yields. So you can apply technical analysis on any chart that is for any financial instrument or any asset. So this is mainly the theory behind technical analysis, or the base behind technical analysis. Usually traders will not only be looking for the price patterns, but also they will be looking how the volume will be changing once the price action is happening. So usually a trader would confirm a certain move with a change in volume. So for example, if the price is going up on the chart, the trader will not only just look at the price when it's going up, will also try to monitor the volume or the momentum when the market is going up. So also technical analysis, it has like even different like there are different methods for traders to use while applying technical analysis. They can go for classical technical. They will be just also using the chart alone, so without using any mathematical equations maybe. So they will only rely solely on the charts. They will be looking for certain patterns taking place, and they will be looking to see how these price patterns will evolve, and they will take their trades accordingly. There's also another type of analysis, which also is under technical analysis, where traders will be using indicators and oscillators. Indicators and oscillators are mainly created within a certain mathematical equations in order to give also some information about the price performance. So a trader would be using these indicators or these oscillators to base their trades on. Some traders also, they can use both methods. So they can go for classical technical, choose just look for certain patterns and get the confirmation on these patterns or on the price movement from indicators and oscillators. So here we're just gonna explain the basics of this webinar. So we'll be talking about different types of charts. So in order to do technical analysis, definitely you have to understand what is a chart, what does it show, how you can change the charts and deal with them. So we can do this also on the MetaTrader 4 platform. After that, my colleague Sai will be talking about tops and bottoms, supports and resistances, how to just collect tops and bottoms and know which are the ones that are solid. And after we'll be talking about Fibonacci extension and retracement. So we have different chart types, but among the most popular chart types, you have the line chart, bar chart, candlestick chart, point and figure, and Renko. So these are different five chart types. Three of them, they are based on time: the line, bar, and candlestick. They are available on the MetaTrader 4 by default. They are based on time, while the point and figure and Renko, they are also based on they don't take time into consideration, but they also only focus on the change in price. So what usually a chart will tell us. So when we used to go to school before, we used to have a certain chart, for example. So this graph, there are some coordinates, and these coordinates they will decide on the plot of the chart. So for example, if the price of let's take into consideration, we're gonna draw the chart of gold, let's say. So we have here the x-axis will show time and y-axis will show the price. So here we have coordinates for a certain point, and the time chart, the coordinates, the x coordinates, they are based on time. So if you choose, you can choose different time frames. You can go for 1 minute, 5 minutes, 15 minutes, 30 minutes, 1 hour. So you can choose the time frame. This time frame will so the chart will show us the price performance or the movement of the price within a certain time frame. But the data that we will get, it depends on the type of the chart, whether it is a line chart, bar chart, or candlestick. So I'm going to start with the simplest, the line chart. So the line chart, what does it show us? The x-axis will be, or the x-coordinate will be the time, and the y coordinate will be the closing price of an instrument. So for example, within a certain time frame, the market was, for example, let's take this minute into consideration. The market is moving, it's fluctuating up and down, the market is moving, and then it closed here at this price. So this price, let's say it is, let's say for gold, for example, it is 1800. Okay, so 1800, the line chart will show me the closing price. It will look at the y-axis, where is 1800. Let's take this consideration that 1800 is this price, and this is the time, so it will show us this, it will plot a certain point that's showing the closing price of the financial instrument or the asset that I'm trading within this time. The next one will be, for example, here, so this will be merged within a line, and this is it. This is how it goes. So for example, the price goes up and continues up, and then it goes down, goes up, goes down. So all these, the line chart will show me the closing price of an asset within a certain time frame or within a certain period. What differs between the line chart and other types of charts like the bar chart and the candlestick chart is that the bar chart and candlestick chart will show me all price components, different price components. Not only the closing price, but the opening price, the highest price reached within a certain time frame, and the lowest price reached within a certain time frame. So this is in base what is what does the chart show me, and now I'll show you the different types of charts. So as I said, it is a line chart. It is similar to a scatter plot, except that the measurement points are ordered typically by their x-axis value and joined within straight line segment, like I showed. A line chart is often used to visualize the trend in data over intervals of time. So usually a trader would look at the line chart to just try to detect the trend. Oh, I'm checking, for example, this is the chart that is in front of me. I'll be able to deduce that the price is going up or there's an uptrend while having little corrections within this uptrend. And if the market is going down like this, I can also know from this line chart that the market is going down. So this is why we use line charts, mainly to detect the trend or decide on the trend of certain financial instruments. So this is the line chart for the euro dollar. This is the recent chart if you're using the daily time frame. So each point, the closing point, it is showing me the closing price of the euro within a certain day. So this is the chart in front of me is showing me that the euro was going up, down, up, down, up, down, and now it went lower than it was before, and it had after that had a certain correction and the market is going up. So all this is showing me the trend. So here the trend was up, here the trend moved down, then here the trend was up, then the market moved down. So all this is a sideways movement. And then the market had the smaller sideways movement on here until breaking lower to a certain new lower territory. So this is also a move down, and here the market is moving up again, small consolidation and moving up again. So so I can dissect the chart within a certain for certain periods in order to show that the trend that is taking place within a certain time limit. So this is the line chart. It's very easy. Moving to the bar chart, which is showing us more components of the chart. It includes the closing price, the opening price, the highest price reached within a certain time frame, and the lowest price. A single bar will always represent a predetermined unit of time. So for example, if I'm choosing the 1 minute chart, each bar will show the price action within 1 minute. And if I'm choosing, for example, 1 day, it will show within 1 day. So for example, let's take into consideration that the price of gold was trading like this. It opened here at this price, and then it went up for a certain level, and then it went down, and then the market closed here at this point. So this price action within, for example, let's take into consideration that this was the price action for today. So this is 1 day. Okay, so how does the bar chart will show this? So first the bar will be like this. This is the open price, and this is the move higher will be shown by a tail to the upside, and then this will show the move to the low, and then this will be the closing price. So this is the opening price here, this is the highest price, this is the lowest price, and this is the closing price. So this is how the bar chart, or one bar, will show the price action that took place within a certain time frame. So moving forward, you can see here that this will show me the opening price, the highest price, the lowest price, and the close price. For example, let's take into consideration that gold is opening near 1900 today. It went to a high of 1910 and then dropped to a low of 1870 and closed at 1880. So the bar chart will be able to show me all these four price components: open, high, low, and close. And also the similar, the opposite for a bullish candle, or a candle that is showing a movement, an upside movement in price. So this is the opening price, this is the lowest price reached within a certain time frame, this is the highest price, and then this is the closing price. So this is these in front of us. There are two different bars. One negative bar or down bar or bearish bar, and the other is bullish bar or an up bar or a positive bar. So this is showing an increase in price, this is showing a decrease in price. How does it look on the chart? So this is the same chart that we saw a while ago on the euro, but we were seeing only the closing prices, so it was much smoother. But now we're seeing bars that they are showing us all the components of the price. So for example here, this is showing us the opening price, this is the lowest price within the day, the highest price, and this is the closing price. The closing price of this day is the opening price of the second day. The market moved higher towards this point and then moved lower to this point and then closed here. So this chart, this bar, for example, is showing me all the four price components. Okay? So the bar in red is showing a depreciation or decrease in price, while the bar in blue is showing an increase or an appreciation in price. So this is the bar chart. The candlestick chart is almost the Japanese version of the bar chart. It's just almost the same. It records all price components, but it is usually a filled or a candle that has a certain body. So I'm just going to show it to you here. These are the same components: open, high, low, close. But this is how a candlestick will appear. This is the body. It is the difference between the open and the close. So this is the body. It will be filled. Usually it is a darker color if the market is moving down, and these are the tails or the wicks that they are showing the distance between the open to the high and the distance between the close to the low. So these tails are marking the highest and the lowest price reached within a certain time frame. Also, on a positive note, if we're trading here on the market is going up, this would be the open price, this would be the lowest price or the low price. The market's going to move to the high, and then the market's going to close here. So this is how the candlestick looks like. Candlesticks, usually there's a certain type of analysis behind it, which is called candlestick patterns. We're going to be explaining about candlestick patterns in a coming webinar. So candlestick patterns, they can be used by traders in order to decide on their trade direction. There are certain patterns that take place, and they can consist of from 1 candle to 5 candles, and they can mean something about the market. So this is also the candlestick chart. Same time. We're using the same time. We're using also the same chart itself. So this is how it will look like when we are trading, when we are using the candlestick pattern instead of the bar chart. So this is the bar chart, and this is the candlestick. I'm going to show you now on the MetaTrader 4 platform how to change between them and how they can look next to each other. This is one of the patterns that they're taken. With candlestick chart, it's one of the easiest patterns: bullish engulfing pattern, bearish engulfing pattern, meaning that for example, here we had the market was moving down within a certain time frame, within a certain period, and then the next period the market was able to recover all the losses and close at the price higher than the opening price of the previous. So this is usually taken as a bullish sign. So the market was able to erase all the negativity, all the drops that was incurred, all the losses that were incurred previously, and recover them and move higher. And here on the opposite, so the market went up. For example, gold opened at 1900, went up to 1920, but the second day it closed down at 1880. This means that all the positivity that was earned during this move of $20 up, it was removed or erased the second day, and the market moved lower. So this is a bearish engulfing pattern. These patterns happen mostly on the chart, and they can be good signals for the trader. So a trader, for example, will be buying here and putting a certain stop loss either here or even lower, and looking for the same also move higher. And on the other side, the trader will be looking for a selling position here with a stop loss here or higher and also the target at the bottom. So this is how you trade bearish and bullish engulfing patterns. Now I'm going to talk about different types of charts. Unfortunately, point and figure is not available on the MetaTrader 4 platform, but some of its concept, for example, with Renko charting, you can get a certain plugin and check it on the MetaTrader 4 platform. So this chart, it consists of a series of stacked X's or O's, each of which represents a set of degree of price movement. For example, this type of chart, it doesn't take time into consideration. We can just, we set a certain increment for a change in price. So for example, if gold moves up $5, I want to mark this move of $5 with an X. If it moves down with $5, I'm going to mark this move down with a no. So I'll be pointing a series of X or stacked X's, and after that a stacked O's. So if the market is going up, for example here the market is moving up, and then the market moved down. So I have $5, $5, $5, $5, $5, and $5. So I'll be here putting X and X, another X, another X, another X, another X. And when the market reverses $5 and another $5 down, that will be a no, another $5 down, another O, another $5 down, another O. So this is how it will appear on your platform. So I'm going to show it to you as an example on the euro dollar. So this is how a certain euro dollar movement will be. So each one of this is a box of 30 pips. So here you can see fixed box size 30 pips. So if the market moves up 30 pips, I have to set this X, and if the market moves down by 30, we have to set a no. But definitely if the market is moving here, so we need the 60 and not the 30 in order to plot the first O. It is a one box reversal. We call it one box reversal. There are different types of filtration that you can use for the point and figure charting. So this is showing a move of 60 pips down, and then this is showing a move of 120 pips up because we have a 30 pips move here, and then another 30, 30, 30, 120. And this is showing another 60 pips move down from the highest price, because here we have also 30 pips, which was denoted by an X, and then we have a no. Here also we have 90 pips up, X, two X's. Here we have a 60 pips move down, and this is how it goes. This is the point and figure chart. Moving to the next chart, it is Renko. Also, it doesn't take time into consideration, but instead of plotting X's and O's, we will be plotting a certain candles, positive and negative candles. The Renko chart will filter out minor price movements, or the noise that we call noise on the charts. This noise sometimes lead to certain losses for traders. So this noise will be filtered out by using Renko chart. The box size represents the magnitude of price movement. So you set the box size, for example, 10 pips for the euro, or for example, $5 for gold. You can place the box in the next column once the price has surpassed the top or the bottom of the previous box by the box size amount. So for example, if the box is X, if the box is $5, so if gold moves on top of this price $5, I have to denote a certain candle to the upside. And if it moves another $5, in the next column I have to put another candle to the upside, and continue this way. And if the market goes down, I have to put a candle that shows a movement down, similar to this. This is the same chart that I was showing to you previously. It's almost the same chart, so it's just missing a couple of days, but in the end it's the same chart. So each one of these candles is showing a 20 pips move. So the blue candle, it is showing a 20 pips move up, 20 pips move up, 20 pips move up, 20 pips move up, and then the market closed here. Then from here it failed to have another 20 pips up in order to put another blue candle, but the market moved down with 20 pips and another 20 pips, and it posted a red candle. The market moved down with another 20 pips to have another red candle, another 20 pips down, another red candle. The market moved up 20 pips, and another 20 we have a blue candle. So this is how Renko chart moves. This is showing me a lot of, it is erasing a lot of noise, and it's filtering out a lot of noise in the market, and it's making it more clear how the trend is. So this is a Renko chart. Now before moving to support and resistance, I'm going to go to the MetaTrader 4 platform to explain to you how you can use these charts. So I'm going to remove this, and I'm going to add, so I'm using a certain time frame. This is the hourly, this is the 1 minute chart. I'm going to use also 1 minute here. and 1 minute here. First, in order to set a chart here on the MetaTrader 4 platform, you just right click on the symbol that you're trading, and then you can go for open chart, and then you'll have the chart here. And also you can drag the symbol to the chart in order to have it on. So this is the chart. You can choose the time frame here, 1 minute, for example. This you can choose 1 minute, 5 minutes, 15 minutes, 30, up to 1 month. And also you can choose the chart type. You have the bar chart, candlestick chart, and the line chart. So I'm going to use here the candlestick chart. This is the candlestick chart. This is a bar chart, and this is a line chart. So the line chart will show me only the closing price. The bar chart will show me all the price components, and the candlestick will also show me all the price components. So if I just have a look here, the market is moving, and we're just going to wait for a new candle to form. So you can see how the market is moving here. The candle is moving up. For example, this is showing that the opening price, we have, for example, if you wave by the mouse over the candle, you can see all the price components. I can see the open is 1774, the high, the low, and the close. So this is until now it is a blue candle showing that the market moved up within the past minute. And this is the line chart that will only denote the closing price of this minute. So this is how these charts work: the candlestick, bar chart, and the line chart. Going to the Renko chart, there's a certain plugin that you have to apply on a chart in order to get the offline Renko chart. The Renko chart will be looking for a certain, so for example here the candle closed, this candle was to the upside, and now the market's moving down, this candle opened and the market started moving. You can see here that the line chart didn't show me all this this change in price, it only noted the closing price, while the bar chart and the candlestick chart were able to show me all the price changes, the up, low, the open, high, low, and close. So this is moving to the Renko chart. So this Renko chart will have to wait for the price. For example, the market, this candle closed at 1740. The market went down. I need to have another 10 pips down in order to have another 20 pips down in order to denote a candle down or a falling candle. But this didn't happen, and the market moved up. So the market moved up 20 pips and another 20 pips, and it closed here. So now what will happen? The market needs to move another 20 pips to the upside in order to denote a blue candle, or to write a blue to show a blue candle, or the market will drop 20 pips and another 20 pips in order to show a red candle that will be placed here. So will be placed here exactly. So we can get the formation similar to this one. So 1, 2, and 3 down, 1, 2, and 3 down, 1 up, 1 down, 1 up, and then we'll have 1 down. So this is how the Renko the Renko chart works. Also, you can add the indicators to the Renko chart. So this is what I have to tell you about the bar charts or the types of charts, different types of charts. And now my colleague Sai will be talking about supports and resistances. And at the end of the webinar, we'll be answering all your questions.
Thanks, Wael. Hello to everyone. It was a great explanation from Wael. We're going to go through the next level of basic informations, which normally we say in a technical terms, where support and resistance. And we are going to cover about some basic informations about the Fibonacci retracements. So basically, support resistance are certain predetermined levels of the price of any market at which will tend to stop or reverse. So basically, talking about the support, when you say about two levels in any markets, normally any traders always like to have this information before they start the trades. If you take for any technical type of indications, any technical tools you use, so this looks very important to notify on any traders as per a day trader or maybe a mid-term traders or maybe a push-in traders basically. So when you're talking about the supports, let's go with this. Buying force of the traders is strong enough to overcome to sell in the price. That means whenever there is a support levels in the market, there, for example, in any day in the market trade, like there will be commonly mentioned 3 levels be mentioned, like for example, support 1, support 2, support 3. We're talking about the resistance same way, like resistance 1, resistance 2, or resistance 3. So when buyers are became more into looking to the support levels. So because whenever the market trading on the one side and market is on one trend, it's on the one side, for example, in the bullish trend, maybe on the bearish trend, if you say like that. So markets on a downside trend. So they look into the support levels, like which level the markets plays, which are the levels to buy back. That means the buyers would get chance, opportunity to buy back at the same levels, at the different levels. For example, the market reached to support 1, this is good level to buy back because sometimes they miss to chance to buy in the higher levels. This is one of the level to buy. So if market reached to second level, support 2, so again the opportunity gets on the buying side for bounce back. So the support order does not always hold when it decline below the level of indications. And same time, the markets are be on the side on the overbuy levels. So basically, we say that it's oversold. The market is oversold when the market's on a trending on the downside directions. So you got a chance to buy on a better price, on a lower price, so that your target range will be higher, as well as stop loss management will be very low, and you will feel more comfortable on this type of support levels. The price can also sometimes break a support, but stay trading near the level of the turn back higher in case a false break is generated. For example, here what it exactly says that most of the cases, suppose like market is on one side directions and markets keep breaking the support. For example, you are plotted at 3 support levels today at the downside. For example, take for a gold, seems to be a fall from the yesterday markets. So you see that there's a bounce back. So always a trader's mind always keep to look into the lower level where to buy back again. So in case the market has tested the support level 1 and it couldn't be able to bounce back due to many reasons, it's a false generated. So again, the market's trying to touch a support 2 level or support 3 level. So that makes sense because you take a low risk compared to the higher level of the support 1 and support 2. So support is always one of the major tool to take care on any trading. From the slide, you can see here a small example, and the small slide chart has been shown here. In the direction of this, it's been taken as a goal actually. So you can see there are many supports level has been marked here. For example, like 1, 2, 3, 4, 5, almost 6. So these are major support levels seen, like as per the historical levels, as per the historical data, this plays them in, because normally any traders, any technical traders are usually psychologically, like basically in any psychological trading, normally all the traders are looking to this type of past or past history to break the future markets. So same way here you can see the supports which been standing here 1, 2, 3 continuously. So whenever they reach that level, it's bounced back. So the buy side markets, the buy side traders always try to take opportunities when they have these levels. So these levels can be on based on a different time frame. For example, you take for a daily charts, like for example, the market closed on the night, and there is a new levels of will be predicted for the coming days or today or tomorrow. So based on that, the levels will be predicted. It's the predetermined levels basically. So there are different types of support resistance based on different mathematical calculations. Normally they follow the standard deviations. Sometimes they follow Fibonacci type of levels. So different categories of support resistance can be calculated. So this is how exactly the support has been held. So mostly the support, the main reason was they are in a sell side market, suppose they are in the sell side and they like to cover the position. For example, they're waiting for the level to reach support 3 and the market has touched the support 1. They try to book the half of the profits or 30% of the profits, and they look into the next level to touch. Some buyers, some type of traders always look to buy back again. So that's a different right. So they look into the bottom side where the important support levels have been touched or triggered. So they want to be on an opportunity to take again back on the buy side. So this is how exactly the support things works here. Let's move on the resistance. Exactly as I said, like in a way of support, and there's a downside where you look to the buy. resistance always the higher side, it is upper side of the markets. So we can see there is the overbought, it's almost overbought levels has been touched. So it seems to be want to be sell side, want to be on a seller mode of the markets. So here the sell resistance, the price can sometimes break a resistance but stay trading near the levels and turn back lower. So that's why exactly. So when I'm talking about the support, the same way for the side of the resistance side, where you can see R1, R2, and R3 at different levels have been plotted. So where one side in the market on the trending side, where we can always traders can look into the levels like R1, they look into the sell side trend. And normally any traders will have this type of information with these levels. They usually go for R1 to be on the sell side, first level, and they may keep a stop loss on the R2 level, and they can keep the profit targets on a S1 level because the market has touched R1, so it may tend to expect to touch support 1. So these are exactly the support and resistance plays a major role here. So keeping on this on the line, we can see there's a graph here. So we can see the major resistance has been seen in this chart as we taken as oil, crude oil as one of the chart placed here. So we can see there's a one support and resistance 1 and resistance 2 and resistance 3. So this plays a major role on the resistance. So it's very important to notify, like when any traders who always look into this type, basically it works with any time frame directions, basically like it works measure on major time directions because it works, it's taken as historical levels of the last week or last month or last 6 months of the data, which plays a major, and whenever the market touch new levels, for example, in case of market touched, gold touched new levels and it's going to correct it back, so that plays a major role, like looks like the important level for the support, like it's at the bottom or maybe the higher level. So this is how exactly the support and resistance plays a major role. And when you look moving to the Fibonacci retracement, so when you compare to the support resistance, the Fibonacci retracement is one of the major tool which used by most of the traders. So when you say like a Fibonacci retracement is one of the popular among the technical traders because it's based on the key numbers identified by mathematical terms basically. It has been came from mathematicians of Leandro Fibonacci in 13th century. So in say like Fibonacci retracement is one of the a method of technical analysis to determine the support and resistance. What we're talking about support resistance, many people doesn't understand much about because they randomly take the support resistance in a way like try to understand in a different levels. Because as I said, there are different types of formulations are there to identify the levels. But Fibonacci is one of the best tools where most of the traders try to identify the support resistance levels. They also named as a Fibonacci sequence, basically, because it's a Fibonacci retracement is a tool which favorite among many short-term traders. Basically, you can say like clearly indicates the level of potential of support resistance where they can find the reasons to enter in the market. For example, when a market is a one-side direction, and this level gives an indication when to buy or when to give a stop or maybe extend the profits or give the stop loss. So exactly. So basically, the Fibonacci retracement is based on the idea of the markets will retrace the predictable portion of the move, after which they will continue to move on a vertical direction. Means like one-side direction the markets, and there are the possibility to correct down for a few levels of the market and bounce back again. So this gives the opportunity to enter back again in the market in the buy side. Maybe if a market is in the downside direction, it's a bearish directions and gives a small correction back and it back again downside. So these are the levels which will continue to move on a vertical direction in the trend-based direct markets. So helps to identify the strategic place for transaction to be placed, target, price, and stop loss. It's a very important point because most of the traders will have a big questions on fixing up their targets or placing the orders or entering into the market or placing the stop loss. So this Fibonacci treatment especially gives the knowledge about like where to book your loss, where to keep your stop loss, where to book your targets. Even it will give the extension of your target, for example, target 1, target 2, target 3, something like that. So using the Fibonacci tools by identifying a major peak and throughout of the charts. That means it identify it to be maintained this tool has to be identified by high and the low, and extremely high and the low of the particular period of the charts. So major horizontal lines of the support resistance levels are identified by the key Fibonacci ratio. So here the ratio is a major levels to be point out because normally it's a Fibonacci sequence numbers. It's namely like we have a coming webinar, we're going to have a brief discussion about the Fibonacci levels and tools. So normally Fibonacci sequence is followed with the Fibonacci series. Starts like 0, 1, 1, 2, 3, 5, 8, 13. It goes on like that. So this has been derived from the same sequence, and which one like we can find out the major point of possible of corrections, the reversal, and the counter trend of the bounce backs. So here you can see the major levels of the support resistance to identify the Fibonacci ratios are the major levels are 23.6, 38.2, 50, 61, and 76.4. So these are the major levels. For example, when the market is in the upside trend and the market is corrected this 23%, there are a chance to bounce back from this level. Or if the market again corrected back to 38%, there are no chance to bounce back. So those are many traders who usually follow this type of strategy. Like for example, market touched the 23% of 6. They try to buy in the same level of the market price and they keep the stop below 38%. If a market touched 38%, they try to buy at the 38% level and keep a stop loss of 50%. So normally in a psychological, many traders will always look at the 50% correction is a major correction and extend it to correct back to the market and bounce back. So this is how the tendency, make sure that any traders who want to follow this Fibonacci retracements of the tool, so make sure that you understand properly what exactly the retracement is and how exactly it is going to be useful when the time of market correlations with the correction side and the markets on one side directions. So here Fibonacci retracement is used to establish profit targets, estimate how to far the price go. A price could go further. That's what I'm saying, because when the market on the one side, and markets moves on one side, on the one trend, so usually it helps you to continue the trade. Even you can have a tool, that this tool has called extension, which will show the how next level of the profit. For example, like market, gold has touched 1,100 and market corrected to the 23%, for example, take for like 1870 or 1870 or maybe 1850, and you bought from that level. For example, it shows a correction of 23% or maybe 38%, and you're expecting where the profit could be. So this Fibonacci retracement extension also gives the direction to give the profit. Maybe it crossed the 1900, it move on to 1930 or 50, which gives the extension of 123% of the levels. So this is how exactly the Fibonacci treatment is useful. From here you can see a small slides which shows a retracement, how exactly it works. For example, if we taken a short-term time period of from bottom to the level of here, like it's like 1748 in a gold, and we taken the bottom level of something around the 1640 or 45, placing a retracement extension from here to the bottom to the top, we can see there is the 100% correct. We kept it at 1733 levels, I guess. So here we can see there is the extension of 76, 61, 50, 38, and 23. So there is the extension was placed at 123%, they got 161%. So this is all we can going to be identify the Fibonacci retracements, but I'm going to show in a better way in a MetaTrader platform, so which can help you to understand where exactly it's going to be a get plot and where you can able to use the tool. So we can see here that you can take it from the view or insert the Fibonacci here. So there is the option here, you can see the Fibonacci retracements. Click on this, and for example, this is a 1 minute chart. Maybe you want to go for a move on to the higher level of the chart. For example, you take for 1 hour, you can see the time frame at certain time period. You can take a plot here on the bottom and try to keep it to the top of the current level, and now we can see the levels here. For example, we taken from 16, we can say the bottom of 1.1693, we taken a euro chart here, 1.1695, and we kept our top level of 1.1807. So plotting the retracement from the bottom to top, we can see there are different levels have been seen here, like 23%, 38%, 50, and 61%. So market has started correcting from there. It's crossed the 23%, and it's again, as I said, like there are chance to give a false signal to bounce back because it has been heavily pressured on towards the 38%, and the free fall it has been continued to 61%. But seems to be like is one of the major levels, because there is a big trend and change happens after 61%. So there is a big chance to buy back here. So if you get a chance to buy at 61%, there is a chance to book your profit at 50 and there's a 38% and touch 23%. So these are exactly, you will keep your tool to identify the Fibonacci retracements of support resistance. And moreover, if you say like a top to the bottom, for example, if the market is falling and we're expecting to be a sell side, so you take the same range of high range of 1.1807 and a recent low of 1.724. So you plot down top to the bottom. Now you can see the correctional downside, which is 23 to 38, and here is the 50, 61. Perfectly, this retracement will work today in an hourly chart. Either side, for example, if you be on a buy side market trend, it is given a chance to give a buy call, buy side. And when the market on the sell side direction, it's going to tend to be a sell side mode now. For example, the 23 is broken, 38 level has been broken, and you can see 50 level as well. You can take a chance here by placing the stop above this level, but given the market is given a 61 is a good level for a downside trend. So these are exactly the technical, the Fibonacci tools have been used for the future trend, especially for the major support and resistance levels for the day or for a weekly or maybe for intraday players.
Thank you, Sai. So if you have any questions, please write them down. I'd just like to remind you that all the information, news, analysis, and opinions mentioned in this webinar only serve for educational purposes and shouldn't be taken as a signal whether to buy or to sell any financial instrument. Okay, so there are a couple of questions, among them the support and resistance level. So support and resistance level, you have to take them into consideration as if it is a certain war between buyers and sellers. So for example, if you just want to, I tell you today that gold is trading near 1900, there's a possibility that gold could go up. You tell me, fine, I'm gonna buy gold, but I don't want to buy at this current level of the market price. So you believe that your best price to buy gold is, for example, near 1850. So you're gonna go and set a certain price level at a certain pending order to buy gold at 1850. Let's say this concept will be transferred to a couple of traders. Many traders will think the same as you are doing, and they will also set a certain pending order near 1850. So when they do calculate, when they do set an order near 1850, they are creating certain buy levels. They are putting some buy orders in the market. So when the market goes down towards 1850, these buy orders will be triggered. And if these buy orders were larger than the selling pressure that drove the market down to 1850, the market will have to rebound. Let's take it into a different way. We have 10 soldiers, 20 soldiers, 10 against 10. So if they're equal, like 10 against 10, you believe, like for example, they're gonna hold each other. But if in a certain, for example, in a certain fight, you have 20 soldiers against 10 soldiers. So the 20 soldiers could be winning the 10 soldiers. Would definitely be winning the 10 soldiers. So it's the same as if you have 20 buyers and 10 sellers. So the buying power, the buying pressure will overcome the selling pressure and will drive the market higher in a certain price. I'm gonna just go to the platform and try to explain to you in also much briefer way. Just let me. Okay, so this is here the chart. This is the euro chart. Okay, so you just can denote this bottom at 1720. So what you have to say is that there are some traders that they will be looking to buy the euro and when it goes down to 1720. So they will start setting certain buy orders near 1724, the previous bottom 1696, and the previous bottom near 1683. So if the sellers were able to come and control in this market here, and then the sellers were able to drive the price lower, so the selling pressure here will be will overcome or will have to fight the buying pressure or the buying orders that are available in the market. So if the buying orders here were more than the selling pressure, the market will react like this and goes higher. If the selling pressure was stronger than the orders available in the market, we will see some movement here, and then the market will continue lower towards another obstacle or another barrier or another buying orders. And if the buying orders here were stronger than the selling pressure, then the market's going to move higher, and vice versa. So this is how support works. It is a fight between buyers and sellers. Sellers are in control when we reach the support zone. Buyers want to regain the control and move the market higher in their favor. So this is what happens. Opposite, and similarly to the resistance. But if the market is going up, for example, there's this certain resistance level, another resistance level, another resistance level. So when the selling orders that are available at these levels overcome the buying pressure, the market will move lower. If they won't be able to overcome the buying pressure, the market will move higher towards the next barrier where these orders will be able to set the control again into bears, and then the market could move lower again. So this is in brief how you can put supports and resistance, how you can calculate them. You had also a question. Also, I have issues calculating pips. I don't know what's your issue with calculating pips. So if you just give us a bit more clarification. There's another question: how can I reduce losing more money? Well, trading is all about adding more knowledge. You have to add more knowledge, fundamental analysis, technical analysis. But the one most important thing is to control your emotions and to set proper risk management. You shouldn't be over leveraging your account. You shouldn't be hesitating with the risk to reward ratio. You shouldn't be leaving some trades without certain exit strategy, or at least a certain stop loss. You shouldn't also be taking so much a bigger exposure on your account, much more than what your account can afford. So these are the 4 key elements that you have to take into consideration when doing risk management that would help you to sustain the market and at least make some profits and not losing your account. So these are among the basics. Moving to taking decisions will have to be based on fundamental analysis, technical analysis. You have to increase your knowledge in these 2 aspects in order to have more insight on what the market could be doing. And then while executing your trades, you have also to respect your money management and risk management. You're most welcome, sir. And then this is it all for today. If you have any questions, any further questions, or you want to know more about anything related to trading, you can just send an email to webinar@icm.com or support@icm.com, and I'll be glad to help you. This is all for now. Wish you safe trading for the week, and hopefully we'll get in touch also in the coming educational webinar next Wednesday. Thank you all for watching. Sai, would you like to add anything?
Thanks to everyone.